Welcome to Allan Reports TV. I'm your host, Allan Labucan from allanberryreports.com. Today we have a new installment of our Week in Review show. As always, there was a couple of issues that happened this week that we're going to talk about. Before getting started, we always like to start with our thank yous. We use youtube.com and ustream.tv to produce and broadcast these shows, so they're available for you to watch at your leisure. Those are great websites for anybody who's interested in doing online programs like this. We also have to send out a special thank you to YouTube this week. A couple days ago, we were chosen as one of the users that are allowed to produce shows that are more than 15 minutes. I guess the key reason is that we have a lengthy history of complying with their terms of use guidelines, so we're very thankful of that. Some of the reasons that, or one of the reasons that I like that is that sometimes doing the shows I feel a little bit constrained by the time trying to get them done. Originally it was just 10 minutes. Then a couple months ago they allowed you to do more than 50 or up to 15 minutes videos, and so trying to get everything I wanted to talk about in those time frames was a little challenging sometimes. So the folks over at YouTube have taken away that worry, and again want to thank them very much for allowing us to be one of those users that can exceed the 15-minute level. Also, if you're watching this show on our website, you'll notice to the left and right of me that there's banners. Those banner sponsors are really important in us being able to bring these shows to you, and I want to thank them. And also, if you'd like to do some homework on those companies, just click on their banners and that will take you to their websites where you can do. They have plenty of information on their various work and efforts, and that's a great place to start your homework. And of course, we also have to send a thank you to you, the viewers. If you didn't show up, we wouldn't have a reason to do the show, and we really appreciate you affording us the opportunity to have an audience to do these shows for. So thank you. Okay, so before we get started, just wanted to also mention that if you're looking to find out about our past shows, if you look below me on the video player on our website, you'll see that we have a bunch of text there, and that will give you links to where you can find our shows. All of our past shows are either on our YouTube channel or our Ustream channel, and so that's a great way to find those past shows. Okay, so the big economic news that happened this week was one of those events was earlier in the week. The White House and the GOP came together with a deal to extend the Bush-era tax cuts. And when this happened, many supply-side economists rejoiced. There's a lot of people out there that believe that when you lower taxes, that this is going to spur economic growth, and the reality is that they don't really work that great to stimulate economic growth. One of the key reasons I believe is that liquidity or having cash is one thing. Having the confidence in your job and your will give you the confidence that you can spend that money, and no matter how much extra cash companies or individuals have in their pocket, if they don't have the confidence to spend, it will have no impact on economic growth, and that's why it's always been somewhat. I know it's been a rally cry behind the political rhetoric of many GOP politicians, but the reality and the results are much different than the political rhetoric. Just look at the Bush era. for a perfect example. During President Bush, President George W. Bush, his term not too long ago, the taxes were at 60-year lows, and during that period, in the early part, post 2001, there was what was for a long time referred to as a jobless recovery. In addition, throughout his Bush era, George W.'s term, the country reached record deficits, culminating in, towards the end of his term, a $1 trillion deficit, and also rapidly growing national debt that pretty much doubled the national debt to $11 trillion. And for most of his term, the U.S. dollar was in a long-term bear market. When you look at the stock market, whether you use the Dow Jones Industrial Average or the S&P 500 as a gauge, it basically went sideways for his whole term, finishing at a level that was near where it started during his term. So whether you look at the performance of debt, deficits, U.S. dollar, or the stock market, there is not a lot of evidence that supply-side economics worked during the much of the 2000s. And then to end it all, in the end of his term, last couple of years, a year and a half of his term, the economy went into the most severe economic slowdown pretty much in history. You could debate whether the Great Depression was as bad or this latest round, but it definitely was a severe economic slowdown. So then when President Obama came into office, I thought he clearly understood Clintonomics. During President Clinton's terms, 2 terms, he raised taxes on the top end, but lowered capital gains taxes. He balanced the budget, and for the most part, got out of the way of businesses to grow. And the rest, that is a perfect recipe for the most powerful economic growth period in the history of U.S. economics. So, I think there's a clear evidence there, at least in the last 20 years or so, that supply-side economics do not work. And Clintonomics of raising taxes on the top end, lowering investment taxes, and working towards balancing the budget and keeping the debt from exploding is a very good recipe for a strong economy, a strong stock market, and a strong currency. Unfortunately, President Obama hasn't seemed to learn much from Clintonomics, and has earlier this week negotiated with the Republicans to extend the disastrous economic policies of the Bush era. And then we look at what are the potential results, and it looks to us like there will be a continuation of record-setting trillion-dollar deficits and rapidly growing national debt that will put pressure on the U.S. dollar for many years to come. To change this scenario will require tough decisions, but there isn't the political will or leadership to make them. To strengthen the dollar will require the serious efforts to balance the budget and start dealing with long-term debt. The biggest expenses that affect the deficits and debt are Medicare, Social Security, and defense. And one thing that many people forget, and I rarely hear anyone talk about, is the interest on the debt. That also has a very big impact on annual deficits. And until they start going after these big ticket items, they can't do anything about deficits and debt. And So, it certainly looks like their efforts are going to continue these record deficits and debt that have had the U.S. dollar in a long-term bear market that doesn't seem to want to, or will be coming to an end. Another event that happened this week was the TV interview earlier this week by Federal Reserve Chairman Bernanke. He talked about his plans to try and strengthen the economy. Much of that has to do with printing more money and trying to add liquidity to an economy that doesn't need more liquidity. It needs confidence. He argued that they're not printing more money. He said that this is a myth because they're, and in a way he's right. It is a myth that they're printing more money. What they're doing is they're issuing digital dollars to buy debt. I'm not an esteemed economist like Fed Chairman Bernanke, but it seems to me that whether you print physical dollars or create digital dollars out of thin air, you're adding to the supply of dollars, and that will ultimately put more pressure on the dollar. His actions are likely to do very little to spur economic growth. I actually believe that the economy, the businesses of the country and the people of the country will do more, and if they gain confidence, they'll do more. Adding more liquidity isn't going to do anything, but his actions are very effective if you want to have long-term weakness in the dollar, which looks like what he wants to see happen. The efforts by the government and the Fed will continue to put pressure on the U.S. dollar, and a continuation of the long-term bear market for the dollar is likely for several years. Yes, during a bear market, you can have rallies. No market moves in one direction or the other. You have counter-trend rallies, and even though the U.S. dollar may be on somewhat of a counter-trend rally for parts of this year, there are very few reasons to get very bullish on the U.S. dollar. Then you look at commodities. On the other hand, they will likely continue their long-term bullish trend, not only because of the fact that we think that there's a bear market for the U.S. dollar, which is the primary currency that commodities are quoted and traded in, but because of the growing demand from emerging economies and which are consuming growing amounts of commodities. Due to the long-term trend, some of the reasons, it's not just about the U.S. dollar that we have a bullish outlook on the commodity prices. Yes, it will have a certain impact, but our main reasons is due to long-term trends of underinvesting in exploration to find new deposits that has been ongoing for the past 30 years. That has caused the supply chains of many commodities to be ill-prepared to meet future demand from emerging and developing economies for those commodities. One of the key reasons we've been long-term bullish on commodities also has to do with demand coming from emerging and developed economies. In our opinion, that if you don't, that investing in commodities and high-quality resource stocks is one of the best ways to get exposure to emerging economy growth without needing to worry about how to pick industrial companies in those emerging economies. You can by buying commodities. The bottom line is, for countries like China and India and other emerging economies to keep growing economically, they will require increasing amounts of commodities that are building blocks to economic growth, and these commodities have supply chains that are ill-prepared to feed their demand. The commodity bull market has been ongoing for the past decade, and it looks to continue to be in solid shape. and likely to continue for the next decade. In addition, many of the commodities we follow look to be headed higher in the long term, but we have long felt that resource stocks are underfollowed, and when you find high quality resource stocks that are undervalued, it gives investors the potential to far outperform bullish moves in the commodities that they have in the ground. With not enough money going into the ground, forgot to turn that off. With not enough money going into the ground to strengthen the supply chains, they've been getting weaker, and it also means that high quality resource stocks are not getting enough attention either. And so there's plenty of value to be unlocked for shareholders of high quality resource companies as we see prices of the commodities they're involved with go up, because it increases the value of what they have in the ground. What needs to happen to better prepare the supply chain of commodities is more money needs to go into the ground to find more deposits to provide commodities needed in the future by developed and emerging economies. Severe supply shortages are likely to happen in the future, and that will bring price volatility. And just because prices are going up, the volatility makes it hard to plan for the future by these resource companies. When you have these big spikes and pullbacks based on supply shortages, it makes it very difficult for those companies to plan how they're going to spend their money, how much money they have coming in. And it takes several years to move a new discovery into production, so that price volatility doesn't help the mining sector. I know it sounds a little bit odd for someone who's bullish on commodities. I'm also making a strong argument for more money to be spent to try and cool that price, because the volatility is what I worry about. In the commodity space, resource companies have been going deeper and finding lower grades, and are progressively having to go into riskier countries to find deposits, and that long-term trend isn't changing. Another issue that brings up is the long-term underinvesting in exploration and new mine development that has caused less people to want to be educated as geoscientists to get into the business, and so there's an supply of key technical people around. In the mining sector, we call the 80s and 90s the lost generation. And what happened during that time is less students signed up to become geoscientists, so there was less in the field, less dollars being spent in the field, meant less jobs. That's why there was less people wanting to get involved. And so then you have this long-term period where there's not enough people in the sort of 35 to 55 generation age, and then you have the 55 years and above who are starting to get out of the business. So this lost generation is another impact on the supply chain of commodities. With resource companies chasing lower grades and going deeper to find deposits and having to look in riskier places to find them, and a lack of key technical people, combined with the chronic underinvestment, these will undoubtedly keep the supply chains for many commodities ill-prepared for future demand, and that doesn't seem to be changing anytime soon. These issues will continue to move commodity prices higher, and this will increase the value of deposits that resource companies own and have in the ground. And these are some of the key reasons that we have such a bullish outlook, not only for commodities, but for resource stocks. And, most of our shows are about resource companies in the news, and there's a very good reason for that. Yes, we have a very strong and bullish argument to be made for commodity prices to go higher, but the resource stocks are underfollowed, and because they're underfollowed, the pricing of the assets that they own in the ground are also being underpriced. Over time, we haven't seen a sort of a recalibration to the current prices. You look at some of the resource calculations and economic evaluations that are done by resource companies when they want to do an estimate of what they have in the ground. They're always using much lower prices to calculate the value of what they have in the ground. So if you're using long-term lower prices, how are these companies supposed to get realistic valuations when the prices are much higher than what they're currently using to do those evaluations? And then if you think like we do that the prices are going even higher, these valuations of what these companies, the value of what they have in the ground is significantly out of whack with reality. And so yes, we're very bullish on many commodities. We talk about several commodities in our reports on this show and in our various different interviews that we do. And ultimately, we not only think that commodities have higher to go, but we think that the real place to look for the best returns is in high quality resource companies. We feel that we've done a very good job in the last 5 years that we've been putting our reports out to find those kind of companies, and we'll continue to do that because nothing we're seeing makes us believe that our argument should change. So that's a wrap on our week in review. Before closing, we'd like to stress that this show and our reports are for information purposes only. We aren't making buying or selling recommendations. It's important for you to do your own homework and speak with your financial advisors before making any investment decisions. We're always trying to grow our audience, and any efforts you make to let your friends that follow the markets know about our reports, our website, and our shows is greatly appreciated. We also greatly appreciate you taking the time to watch these shows. We know that everybody is busy these days, and we strive to produce a show that saves you time and brings you helpful, high-quality information. Our next show will be early next week, another installment of our In the News segment where we'll be talking about resource stock companies that have had recent developments. The best way to keep track of our work is to be on our email list. If you look above me, you'll see a subscribe button. Just fill out the information in there. There's no charge to be on our email list, and we send out notes our emails whenever we're doing public speaking engagements, putting out reports, doing these shows. And so we try to keep our email list very updated on the work that we're doing. We hope you can join us for future shows. You can find all of our work on our website at allanberryreports.com. We'll see you soon, and have a great day.